Hello everybody and welcome to this video where we will be running over the top 5 retail stocks. We have today selected the following 5 companies. First we have Walmart, stock ticker WMT. Then we have Costco Wholesale, stock ticker COST. We then have Target, stock ticker TGT. We have Dollar General, stock ticker DG. And finally we have Dollar Tree, stock ticker DLTR. So first we want to understand how these stocks have been performing over the most recent periods and whether they're in what we consider uptrend or downtrend. And as we can see here, most of the companies have the green color, which means that they are gaining in terms of market value. The only exception that we have is DLTR, which has actually been performing relatively poorly compared to the others and lost 1.45% throughout the year. However, it is worthwhile to note that for the last half year, it has gained 31.55%. Otherwise, across the board, DG has done really well with 35.91 year to date, 24.31 for TGT, COST with 31.30, and finally WMT with 18.69. So across the board looking really fine with the exception of DLTR, which is a little bit more mixed. Next we go to the income and want to understand whether these companies are earning any money in the end of the day. So first we can take a look at the net income for the 12 trailing months and we can see across the board all of them are green, so that's really solid. All of them are earning money. Then we can take the net profit margin average for the last 4 quarters, benchmark against the industry. Walmart doing really fine here with 3.29. COST a little bit worse with 2.31, TGT 4.05 really well, DG really good here with 7.37, that's really good numbers, and DLTR also has a respectable 3.63. Then we can check the BNSM score, which is a mathematical model that determines whether a company has manipulated its profits. We want this to be less than minus 0.22, and we can see for the ones where we have the numbers here, it's looking really fine, no warning flags. The same if we look at the Sloan ratio, which identifies if a substantial part of the earnings are non-cash accruals. We are not interested in that, and we want this to be between minus 10 to 10%, and we can see all of them are in the safe zone. So far looking really fine for all these companies. So just quickly to run over the ranking, we saw on the stock part that all of the companies were considered an uptrend besides Dollar Tree, which is a bit more sideways. It has been done pretty poorly for year to date, but for the last 6 months it has done much better. On the income part, it was positive on the net income for all of them, and the net profit margin average for the last 4 quarters, Dollar General was doing the best, followed by Target, Dollar Tree, Walmart, and finally Costco Wholesale. Next, linked to this, we will look at the return metrics and we want to understand how high return and cash flow margins is being generated by these companies. And if we first take the earnings yield, benchmark against the S&P 500 average, we can see all of them are performing very well with the exception of COST. Return on invested capital, another important metric for us, benchmark against the industry, we can see that WMT, COST is not doing too well, TGT and DG doing really well, and DLTR it's still also doing pretty poorly here with 6.81. On delivered free cash flow margin, WMT 4.41, pretty okay, COST a little bit worse with 2.45, TGT doing really well here with 7.60%, DG doing the best with 9.91 and DLTR respectable with 5.93. So overall looking pretty fine for this type of company. Then we go to the balance sheet and we want to understand how strong the financial position is. And we first take a look at the current ratio. We can see a small red flag here with WMT that only has 0.79, but otherwise it's looking quite stable across the rest of the companies. On the cash ratio part, yeah, this is a very capital intensive industry. So again, usually I would like this to be above 1. However, this is not really achievable for this type of company. But again, there's not really any huge red flags here to me. Then we look at the total ratio, and again, we want that to be above 1.5 if preferable, and we can see more or less all of them are relatively close. So again, it's not super good, but it's neither totally poor. On the debt equity ratio, all of them are in the green zone. The best one is DLTR with 0.47. Then we can look at the Altman Z score, which is a credit strength test that assesses the likelihood of bankruptcy. We want that to be above 1.8, and we can see all of them are far above that. So again, no really warning flags here. The same with the Petrosky score that just assesses the company's strength, and we want that to be above 5 or at least 5. And we can see that all of them are scoring above. So the financial health of these companies looks pretty well. Back to the ranking overview, we first look at the return on invested capital, and what we saw was that Target was the best, followed by Dollar General and Costco. On the levered free cash flow margin, Dollar General was the best, followed by Target and then Dollar Tree. On the balance side, on the total ratio, all of them were close to each other, but Walmart was the best, followed by Costco. But again, all numbers were quite fine here. The same with the debt equity ratio. Dollar Tree was the best, followed by Dollar General and Costco Wholesale. But again, all companies were looking fairly fine here. We then move into the shareholder yield, and we want to understand how much value is returned to shareholders either through dividend and or buyback. So first, if we look at the dividend yield, we can see that Walmart compared to the industry is paying fine 1.61%. COST is not living up to the industry standard, only 0.73. GDT also fine with 166. DG 0.64, nothing noteworthy, and DLTR does not pay a dividend. If we look at the buyback yield benchmark against this at P500 Q1, we see that Walmart and COST is paying below, while as TGT and DG is paying above, and DLTR has a small insignificant buyback over the last 12 months. So the total shareholder yield, Walmart is okay, 2.29, COST nothing really noteworthy, really good with TGT on 3.61 and 3.45 for DG. But again, we want to understand whether this is sustainable, so we want to have a look at the modified payout ratio. Here we want this to be below 100 because that means it's sustainable. We don't want it to be above. So Walmart pretty fine here. COST has a lot of room for improvement. TGT a little bit on the higher side, but I think they could cut the buyback without any issues and still maintain a pretty okay dividend. And DG is looking really fine here. They have a lot of room for improvement. And DLTR, yeah, not really relevant to look at here. On the earnings per share growth, we want to understand whether these companies are expected to grow in the future. First, we can look at the price earnings ratio here and benchmark with the industry. They actually all look a little bit expensive from this side off. They're all in the 22 range besides Costco, which is almost at 40. So that looks relatively expensive. Then we want to really take a look at the earnings per share growth forecast for the 5 next years. And again, benchmarked against the industry is looking really good across the board here. Walmart on 6.41, 7.05 for COST, 7.08 for TDT, really high 14.79 for DG, and a very good solid 9.66 for DLTR. You cannot use the past to predict the future. However, I always think it's important to look at how the revenue growth has been for the past 5 years. And again, Walmart, COST, TDT, DG and DLTR has actually done better than the general industry. And I would specifically highlight DLTR here with 27.55%, really, really good numbers. Back here in the overall ranking, we first took a look at the shareholder yield, and based on my own assessment, the best is Dollar General, followed by Target, Walmart, Costco, and finally Dollar Tree. If we then go to the EPS growth forecast for the next 5 years, we saw that Dollar General was doing or expected to do the best, followed by Dollar Tree, Target, Costco, and Walmart. And a similar story was in the revenue growth for the past 5 years. It was Dollar Tree doing the best, followed by Dollar General, Costco, Target, and Walmart. But again, numbers for all the companies were actually quite good compared to the industry. We then move into the section where we want to see whether these companies are currently under or overvalued. So first we can look at the PEG ratio, the projected earnings growth ratio, and we want that to be below 1. If they're below 1, according to Peter Lynch, they're considered undervalued. If they're above 1, they're considered overvalued. And as we can see across the board, all the companies according to this are overvalued. The only one coming slightly close to 1 is DG with 1.55, but again, all of them are overvalued. Then we can look at my own fair value intrinsic estimator, which is based on a lot of different numbers and assumptions. And here's actually quite interesting because according to my analysis, all companies are currently undervalued and has therefore upside potential. All of them between 2.4 with DG all the way up to 7.31 on TGT. Then we can also look at the beta ratio, which is basically a risk volatility metrics that tells us how much these stocks are moving in general to the overall market. And if it's below 1, they are moving less than the overall market, and all of them follows that. So they are not that volatile, these companies, which is quite normal because they are in consumer goods, which is something we always need. Next, we can look at some other value indicators. One of them is to look at the book value per share. And again, if it's less than 1, they are considered overvalued. If they are above 1, they are considered undervalued. And again, from this metric, all of them are also considered overvalued. Then we can look at the relative strength index here for the last 14 days. If that is below 30, it means that it's oversold and there's indication of that the stock will move upwards. Whereas if it's above 70, it's considered overbought and it may trend back. And as we can see, all companies are in the higher side of the middle section, with the exception of TDT, who is just crossed to become in the overbought section. So that is a little bit of a red flag for them. Next, we can also look at the analyst perspective. And again, I don't follow them blindly, but it's always good to stay on the same side as them if the numbers tell so. And actually, all of them has, similar to my own evaluation, a buy target on these. And the consensus estimate down here, which is basically just the middle ground of all the estimates, which means that some of them are obviously lower, some of them are higher. It shows there's a small downside to Walmart, small upside to COST, 12% downside on TGT, 1.95 upside on DG, and a very nice 15.32 upside on DLTR. So back here in the ranking overview, we just looked at the intrinsic value, and the overall value assessment from my perspective is that Walmart is fairly valued. The same with Costco. Target is overvalued. Dollar General is fairly valued. And the only one who is slightly undervalued would be Dollar Tree. So to round out this analysis, we have been looking at 5 companies who in general all are showing pretty solid numbers. However, none of them are too exciting compared to the price today. I don't see a huge upside potential for these companies, so it's not something that I feel like I need to invest in as of today. However, if we should look at who would be the top pick, if any of these companies, it would be based on a net profit growth of 33.93% in the last 12 months, acceptable free cash flow margin of 5.93%, lowest plus 5 year-on-year debt equity reduction, expected increase in earnings per share for the next year, an attractive growth forecast and still value potential compared to the other companies that we looked at. We believe that the best one would be Dollar Tree. If we were to select another or 2 other companies, that would be Walmart and Dollar General. However, as stressed, I do not see a huge upside potential for these companies. But again, they are relatively stable in these kind of crisis situations because the products that they're selling will always be in demand. That was all for today. We hope you enjoyed the video. Please comment, like, subscribe for future notifications. Please check out our Patreon site where you will get great additional bonus content, which we will illustrate in a future video. Otherwise, have a nice day.